Welcome to the panel, second panel of the conference on challenges for policy after the return of inflation, new directions for research. My name is Oleksiy Kryvtsov. I'm a senior research officer at the Bank of Canada. I'll be a moderator today. Yesterday, we had a policy panel, very interesting, exciting panel with excellent panelists. And they raised a number of questions that concern policymakers today, in today's context. And so, in a sort of natural pivot to today's panel, the focus is on how research, academic research, research in central banks, can be useful in identifying questions that have answers potentially useful for policymakers. So there's a synergy between yesterday's panel and today's panel that I will try to bridge in some of my questions today. Okay, so the goal is to distill the questions for research that are useful for policymakers, and we'll try to think of answers that are policy relevant. I also hope that in our discussion we'll touch upon the toolkit that central bankers use, which researchers have comparative advantage in developing and maintaining. So I hope we'll touch on discussing, what kind of data are useful, methods, models that central banks use, what can be done to improve them. Okay, so for all of that, we have what I think is an excellent panel, which I have a pleasure to introduce. So in the order of speaking, we have Edward Knotek, who is a senior vice president and director of research at the Federal Reserve Bank of Cleveland. Ed's career as a central bank economist spans nearly 20 years. Then we have Catherine Mann, who is an external member of the Monetary Policy Committee at the Bank of England and a professor of the practice at Brandeis University. Among many of her previous positions in policymaking and research organizations, Catherine was the chief economist at Citibank and the OECD. And finally, we have Ludwig Straub, who is an assistant professor of economics at the Department of Economics at Harvard. Ludwig has an exciting research agenda in macro and international macro, including highly cited papers on fiscal and monetary policy interaction and models with heterogeneous agents. So I hope you agree that we have a perfect mix of economists who understand research and who understand how research can help policy. So, like yesterday, we'll start with a round of short opening remarks, and then I will follow up with a few questions and give the audience a chance to catch up and think of their own questions, and then we'll open the Q&A. So with that, I'll go to Ed first. Ed, take it away.
All right, thanks, Oleksiy. All right, thank you. When you said I was 20 years in central banking, that's longer than I usually think about, so thanks for putting that in perspective. And thanks to the organizers for organizing this session. This is really exciting. I'm very honored to be here today. So my goal as a policy advisor is to highlight a few questions that are certainly on my mind as I'm doing my advising. And I think it's obvious that this conference shows that there's a lot of work that's already going on in these topics and related topics, and so that's fabulous to see. And I think the one thing that I'd like to emphasize up front is just that central banks are doing frontier research, but they're also a source for data and information for all of you doing your research as well. So whether that's measures of inflation expectations, there's lots of series that are out there, there's great data. Central banks are ideally situated to bring in information from business contacts and the public, and then they're also calculating a lot of statistics. So whether it's medians and trimmed means or moments of the distribution like the Cleveland Fed, Atlanta, New York, San Francisco Feds, there's a lot of great data out there. Of course, the usual disclaimer applies. These are just my views. So let me first talk about two broad topics. First and foremost, inflation expectations. So certainly on this program, there's a lot of interest in inflation expectations. This interest predates the pandemic, clearly, in no small part because of the prevalence of the new Keynesian model with its forward-looking agents. So there's a few questions here among the inflation expectations topics that I wrestle with. And first is just whose expectations matter and whose matter the most. So if you look at like a FIRE world, a full information rational expectations world, of course, all expectations should be the same. Everybody has the same information set, the same model. But I think we all know that there's abundant deviations from FIRE in the real world. And there's tons of heterogeneity out there. So we just take a step back. You have household expectations. You have business expectations. You have professional forecasters' expectations. You have financial market expectations. And just for good measure, at the Cleveland Fed, we do a little bit of all of those things to cover all of our bases. So we have multiple measures of household expectations, one that looks at category level expectations, one that looks at indirect consumer inflation expectations. We are continuing the survey of firms' expectations that Koybern and Grodnichenko developed in 2018. And then we have our own in-house measure of inflation expectations that distills information from financial markets in terms of the yield curve and inflation swaps, and from professional forecasters. There's the New York Fed, the Michigan, the SPF from the Philly Fed. So again, the central banks are intimately integrated into producing this information. Now it's very clear that for a particular time horizon, and at any point in time, these expectations differ, sometimes greatly, across these types of agents. And so the Board of Governors produces the index of common inflation expectations, which extracts a common factor, which can be nice to talk about similarities. But there's big differences too. And so I think a key question is, how do we reconcile those differences? And what, if anything, do the differences tell us? So, are the similarities more informative or the differences more informative? So when all the series increase, is that telling you something about the persistence of that shock? Is it telling you something about what inflation is going to do? Or is it just telling you that there's been a big shock to the economy? And if there are differences, do we run the risk of ignoring the ones that are least convenient for our theories and focusing on the ones that we can best explain? And of course, that's pretty dangerous for policy. Second, how do different expectations matter? So I think the knee-jerk response is usually one of partial equilibrium, right? So consumers' expectations matter because they're affecting the consumption-Euler equation. Firms' expectations matter because they're driving pricing decisions. Financial market expectations matter because they're driving the yield curve and the term structure of interest rates. But in GE, of course, these things should be related, but are they really, and how do we relate them? So in a recent paper with economists at the Cleveland Fed, Atlanta Fed, and New York Feds, we asked firms, what do you think is most important for your price setting? They said demand, okay? So if demand is driven by consumer inflation expectations, that's a good thing to know. They rate their own inflation expectations as far less important for their price setting problem. But if you look at an RCT world, if you think about the RCT evidence very seriously, even there's a lot of conflicting evidence about what inflation expectations do to demand, okay? So there's a lot of really rich things that we need to figure out about the role that inflation expectations are playing. So third, what should we make of the whole distribution of inflation expectations, both within but across groups, okay? And so here, obviously we like time series, so a median or a mean is a very nice statistic to calculate and plot a very nice chart, see how that moves over time. But this is just a tiny part of the picture, and Ricardo Reese has some work on this topic. So, if you haven't looked at the microdata underlying these surveys, you should. The amount of heterogeneity is staggering. If you have looked at it, I'd suggest look at it again, because again, the amount of heterogeneity is staggering. And this is especially true among consumers, right? We've seen this a little bit at this conference. And that's true even when you have nudges in the survey that are trying to prevent it, or even if you do cleaning to the survey. Heterogeneity is still tremendous. Now, certainly there's a lot of work, including by people out in this audience, trying to source the heterogeneity. So, we know that numeracy matters, financial literacy matters, IQ matters, age, lived experiences, gender, all these things matter, education. But to be clear, those explain like a tiny fraction of the heterogeneity that's out there, okay? There's a lot of work at the Cleveland Fed, among many others, that's looking into that, but there's so much heterogeneity. And so, this raises the question, is removing or ignoring the outliers the way to go because they're pure survey noise? Or are those outliers telling us something fundamental about the importance, the actual importance of inflation expectations for people's decision making? So, I think that's a key open question. Again, if we're ignoring the outliers to conform to our theories, that's a dangerous place to be. The fourth thing then is which expectations matter. And here I'm thinking about like short-term versus long-term expectations. So I think that most of us, if not all of us, could agree that having long-term expectations lined up with the central bank's target is a very nice thing. It suggests that there's some credibility around that target. So we'd like to have them lined up with the target as opposed to far away from the target, everything else equal. And central bankers often focus on these long-run expectations for reasons of credibility and anchoring. But it isn't clear that long-term expectations are more relevant for decision-making that actually takes place. And so you could certainly appeal to the Keynes line about the long run here. So I'm very sympathetic to analyses like Werning's that suggest that short-run expectations should be playing a bigger role in decision-making. Think about it. We live in a Twitter world. Attention spans are short. Short-term expectations are maybe the more relevant thing for planning horizons. But even here, I think we need to be very careful, right? There's lots of evidence out there that short-run expectations are highly influenced by idiosyncratic and volatile components. Things like gasoline prices, food prices. Again, a lot of work out of the Federal Reserve banks, including the Cleveland Fed, on these types of things. So taken at face value, does that mean that every time you drive by a gas station, your decisions are going to change? That seems a little bit extreme. There's also a lot of evidence suggesting that these are more correlated with lagged inflation than future inflation. So, if we take a step back, how important are short-run inflation expectations really as the drivers of activity? And while I've certainly talked a lot about inflation expectations and think they're important, are we really maybe focusing too much time and effort on a second or third order thing and omitting the first order drivers of behavior? So let me move topics then and talk about inflation modeling and forecasting. So before the pandemic, there's a lot of concern about the death of the Phillips curve. Maybe it was better to say that it was just sleeping. Certainly our models had it in the background, but it wasn't always playing a central role. There were debates about the flatness of the Phillips curve. Has it become completely flat? What does that mean? And if you tried to estimate reduced form Phillips curve, you could sometimes find nothing. So kind of depressing. Well, certainly econometrically, we know that large shocks help with identification. So maybe the only silver lining of the last few years is that we've had large shocks. And so we've seen some identification. So this has led to an explosion of interest in the Phillips curve once again. Thinking about nonlinearities in the Phillips curve, the slope of the Phillips curve, has it changed? Thinking about the role of supply shocks and demand shocks in inflation. Thinking about the components of inflation. At the Cleveland Fed, we've been thinking about rent inflation, new tenant rent inflation, and doing some bottom-up analyses. And again, these things are being talked about at conferences like this one. Certainly the Cleveland Fed has research on all these topics. But I think the big question here is just, has the pandemic created long-lasting changes to the inflation process? Or is this a special shock that's going to dissipate, maybe soon, maybe in a little while? And so I think, based on my past history doing some forecasting, one of the most stringent tests in the states to Atkinson and Ohanian is whether a model can help you forecast inflation. So before the pandemic, if you look at the forecasting literature, Faust and Wright basically argued that if you had a good nowcast and you have the SPF long-run inflation expectations and you just connect them with a little bit of persistence, that in general was a pretty good forecast and it was hard to beat. So in other words, if you translate that econometrically, the inflation gap followed an AR process with little persistence. Now, as Rudd's noted, it's not clear why SPF inflation expectations are the anchor. They aren't the price or wage setters in the economy, but we'll leave that for another day. So the open question here is, why is this very parsimonious model so successful, or has been so successful in forecasting inflation? Does it reflect forecast accuracy during a period of overall small shocks to inflation, stable inflation expectations, so kind of the good luck hypothesis? Does it reflect relatively stable and stabilizing monetary and fiscal policies, so the good policy hypothesis? Or is this simple model among the best we have? It doesn't really do very well because inflation is very hard to predict, but it just beats others. So if so, if it's that last one, that doesn't provide a lot of comfort for forecasting inflation. So I think there's two interpretations. One is hopeful, right? Is that there's a better model out there, whether it's structural or a time series, and we just have to discover it. But the more pessimistic model is that forecast-based policy runs the risk of continuously having the wrong forecast. And so again, that's kind of a danger for policy. But again, taking a bigger step back, so if we were in this regime of these small deviations from a stable trend, it's hard imagining a more innocuous inflation regime than that one, okay? So we've really been very lucky. So if the pandemic has truly ushered in a new regime for inflation, it's probably not going to be a good regime to be in. It's going to mean that we're hit with larger shocks. It's going to mean that we're facing unanchored inflation expectations. And we're likely to see more persistent movements in inflation. And so, I think that raises the open question of what is it going to take for monetary policy to offset those shocks on an ongoing basis. So with that, I will stop, but thank you again for your attention. I appreciate it.
Thank you, Ed. And Catherine, please.
Well, thanks very much. I appreciate the opportunity to come and see some old friends and really get a sense of just how much work is being done. I've described this as a tsunami of research of relevance to policymakers like me. Need I say, of course, that this is an exciting time for doing work on inflation. As the three of us were, or the four of us were having conversations preparatory for these for this panel, the way I was describing it was there's a policymaker, research directors, and an academic walking into a bar to talk about inflation. And the question was, would they all be speaking the same language or be completely different? Where was the Venn diagram of the three of us, the four of us, going to be able to come out of that bar with a set of, yeah, we need to go work forward on these things. So I'm going to give you an idea about how I use research in my decision making because, as a policymaker, I pay very close attention to the research that people do, that you have been doing, and in fact, probably more attention to the research that's done internally at the Bank of England and other central banks than is done externally in the academic environment. And the reason why is that as an internal, I'm an external member of the Monetary Policy Committee, but I'm an internal in the sense that I get to see research as it is being developed. And I am perfectly happy to be looking at research that hasn't necessarily crossed all the T's and dotted the I's, because I can evaluate the extent to which that research is going to be very important in my decision making. So let me give you some examples of research that was very important in my decision making over the last year, and then talk a little bit about 4 areas that I think need attention, or certainly if you were to work on that, I would be very grateful because I think it would be helpful in my decision making. Last January and February, so that was the beginning of 2002, so before even Ukraine. There were 2 pieces of research that were made available in the process of our policymaking decisions on research on policy under inflation uncertainty. And there were 2 different types of inflation uncertainty that were being evaluated by this policy work. One was uncertainty about the measurement of inflation. And with regard to what Ed said, a number of factors coming out of what he was mentioning. The second type of uncertainty was uncertainty with regard to the relationship between inflation and other variables. In other words, the inflation modeling process. So what came out of both of these different pieces of research, the first one using the decision maker panel, which is our firm survey, and the second one being a more traditional kind of macro modeling. I have a price stability mandate, a remit of 2% inflation, headline inflation at all times. It comes from Parliament, I didn't make it up. And what that research revealed was that if that's your mandate, and these are the kinds of uncertainties that are prevalent in the environment, then it is better to front load your policy decisions. That in an environment of inflation uncertainty of these two different varieties, it is better to front load policy moves. And that's because you have a mandate and there's a bias to the upside on the measurement of inflation and a bias on the upside in the modeling of inflation dynamics. Now, the second piece of research that was being undertaken on policy was the relationship between policy inflation expectations in a Phillips curve model with drift. So again, there's a theme here that is similar to what Ed brought forward. So inflation expectations and inflation itself are related through the degree of backward-lookingness. So we've already left rational expectations behind a long time ago, guys. My economic advisor, Leonard Brandt, devised a variety of scenarios where we could run evaluations of how inflation expectations, this mechanism of backward-lookingness, varied over time, and the consequences of that backward-lookingness of different degrees would be affecting the drift in the Phillips curve and would therefore affect the extent to which I would have to move my policy rates in order to get me back to my 2% objective. And it didn't take very much at all in terms of backward-lookingness to move into an environment where I had to move a lot more. Otherwise, I was going to deviate from my target. And the worse it was, I would also be making a output gap deviation worse as well. My economist advisor, Natalie Burr, just finished her master's thesis, and it was on the extent to which there was a relationship between policy moves and changes in expectations, looking at firms, financial markets, and households, because we have these detailed data for all of them. She explicitly incorporated into her analysis not just the mean, but the distribution and skew. And the conclusion that came out of that was my policy decision itself on the day, because you can use daily data, right? On the day was factored into firm expectations and financial market expectations, kind of in the direction that you would expect, me tightening, reducing their expectations, but not for households. And this becomes very important because if households, in fact, respond to, quote, quote, me tightening with, believing inflation is going to be worse in expectations, then that creates a very difficult dynamic between the household and the firm as they evaluate, what the prices should be and the extent to which households discipline firm pricing strategies going forward. Now, the implication of both of these two different kinds of research for my policy decision was that inflation expectations, my policy decisions could affect inflation expectations directly, creating an independent channel of monetary policy beyond the standard demand channel, credit channel, portfolio balance channel, demand channel. So this set of research, inflation uncertainty and inflation expectations, were very important as an underpinning of my votes last year, which tended to be outside the majority on the high side. So I'm a hawk, and I was very hawkish that last year, and the reason why was because I had this set of research that was giving me guidance on what would be the best policy moves to achieve the objective of a 2% target. So I could talk more about other research, but let me go through 4 areas that I think are of greatest interest to me as we proceed to make policy decisions every 6 weeks in order to achieve a price stability remit. The first one, Ed has talked about it quite a bit, but I'm going to double down on this issue of understanding inflation dynamics. Clearly, they are asymmetric. There is evidence of persistence, stickiness, embeddedness, backward-lookingness. I mean, we're working through the entire thesaurus here to come up with words to describe inflation dynamics that that decelerate more slowly than accelerate. The evidence comes from the survey data and from the household data as well. It comes from the granular CPI data that the UK has available. The right tails, skew is extremely important. The right tails of these distributions, we follow them from month to month to evaluate the extent to which the right tails are still heavy, whether they're tightening in or not, because that is a very important piece of information about the prospects for inflation deceleration going forward. So volatility, skew, or the whole distribution, particularly the skew, critical work needs to be done on that in order to evaluate prospects for inflation to decelerate. The second area that I think requires deeper consideration is, what are the costs of duration above 2%? I mean, that's kind of everybody's target, so I'm just going to use 2%. We hear a lot about the costs of over-tightening. There's a lot written about the costs of over-tightening. But I actually haven't seen a whole lot of empirical work on what happens when the time period above 2%, or whichever your target is, the time period above 2% continues, is longer, is longer, is longer. Ricardo Reis has done a little bit on it, but only with regard to inflation regime switching. And there's I think there's more to be done on what are the costs of long-standing periods above 2%. Often it is couched in terms of central bank credibility, whether it's anchoring using medium-term and longer-term inflation expectations as an indicator. But I think there's more to be done here. And it's particularly important because so many of us say, you know, we need to do more now so that we don't have to do more later. Well, what does that mean, except for that there are costs of not doing more now? So I'd like telling me more about what those costs are, because it's an important counterpoint to those who say, well, don't tighten because, you know, you're going to over-tighten. This is also a long set of topics we could draw on with regard to lags. I did a whole speech on basically saying the 18 to 24 months lags is, you know, probably not really the one we're working with anymore. So that brings me to my third topic, which is the monetary policy transmission mechanism, the MTM. I think it's very important to consider three stages. There's what I do on the day, the announcement day, the change in the policy rate. That is a transmissions through to financial conditions. It's a very, that in of itself is a broad topic area. And then the transmission of financial conditions to the real economy and inflation. So what's fast, what's slow, and why? This is particularly important because if stage one, meaning my decision, gets transmitted very quickly through to financial markets, then if I keep, you know, if I change my, if I do a increase and then a pause and then another increase, that creates some volatility, and that might in fact end up leading to a longer lag in the second stage. So where this becomes relevant is, you know, how can we contrast as policymakers a yield curve that looks like this, you know, it's very steep, but also a very, very significant inversion. What is the implication of that shaped yield curve and the role that I play in it for the real economy versus high, not quite so high, and hold for longer, a plateau? One's a mountain, one's a plateau. You know, there are different, we know that there must be differences in how these gets transmitted to the real economy, but we don't really have much research that informs us on that. The last point that I would bring to bear is to come back to the forecasting question, and then I will be done. We have a model-based forecast, as does every central bank, and we have multiple models, as does every central bank. And I think what we are challenged with in terms of presenting our forecast to the powers that be out there, whomever they are, the households, the firms, the financial markets, the media, is that model is inherently, it is symmetric, it is linear, it is assumed to be anchored. Inflation is assumed to be anchored. I mean, if we had a forecast that said it wasn't anchored, that would kind of be a problem. So it's symmetric, it's linear, it's anchored. But we really have to consider in this environment that we are in right now that we're not in a symmetric world. We are certainly not in a linear world. We believe we're still anchored, so that's okay. But how does the deviation from symmetry and linearity get incorporated into a forecast? We have many models and many research papers that are put forward to help us understand in a partial equilibrium framework inflation dynamics, labor markets and wage dynamics, and increasingly focusing on spillovers. And these are formalized in our presentation in the monetary policy report with the difference between the modal forecast and the mean forecast. And in our last two monetary policy reports, we have emphasized the rather large difference between the mean and the mode. In our last monetary policy report, the skew, which is the difference between the mean and the mode, was 0.8. It was on a modal forecast of 1. You add on 0.8 and you're pretty close to 2. So the difference between mean and mode become a very important part of communicating our uncertainty about the linearity and the symmetry associated with our forecast. Thank you.
Thank you, Catherine. And now we go to Ludwig.
Great. Perfect. Well, thank you very much to the organizers for inviting me to participate in this wonderful panel. I really like the idea of trying to figure out what the intersection in the Venn diagram is. I hope we can, at the end of the day, find a non-empty intersection. But it is going to sound a little different from what I have to say from my previous two speakers. So I'm going to focus on 3 topics where I personally, and hopefully some of you also, learned from recent macro research. The topics are going to be, first, research on the Phillips curve. Second, research on the sources of the current inflationary episode. And third, research on the sources of inflation persistence going forward. I'm going to try my best to mention at least a few research papers as I go through these 3 topics. So let me start by discussing some research on the Phillips curve. Now, broadly speaking, you can lump research on the Phillips curve into 2 distinct camps. And I'm going to call them the macro approach and the micro approach. The macro approach is kind of in line with what Ed and Catherine described as being used in central banks right now to forecast inflation. This approach typically leverages aggregate or cross-sectional data to inform the Phillips curve. And typically, pre-COVID, when you run these regressions, you find a very flat and a very inertial Phillips curve. Think, for example, of the recent work done by Hazel, Horanyo, Nakamura, and Steinson, who find a very flat Phillips curve across US states. Or any of your favorite estimated DSGE models also typically find very flat Phillips curves with a lot of inertia. Now, I think this macro approach is great at informing the dynamics of inflation after typical shocks that happen frequently in sample. But it may not be the right approach for unusual shocks that do not happen very frequently in sample. And for that, research suggests maybe we want to turn to a different approach, which I'll call the micro approach. Now, this approach tries to think very hard about who actually sets prices and what their objectives may be, in hopes of potentially, at the end of the day, writing a model that allows for out-of-sample applications, right? And this approach has settled on, I think, a very reasonable set of models that we call state-dependent pricing models or menu cost models. A lot of people in the room, including Oleksiy, Raphael, and a lot of you have contributed to this research. I even worked on this myself. And these models are very successful in capturing individual prices, and they have some interesting aggregate implications too. For example, these models suggest that there's some nonlinearity in the Phillips curve. If you have a large positive or even negative shock, these models suggest that the Phillips curve steepens. Okay, there's some nonlinearity there. Very interesting sort of out-of-sample prediction for maybe the current episode. However, there's just one big problem with the current research, and that's where I want to, set out an avenue for further research that maybe some of you might want to go into. The problem is these micro-consistent models are not macro-consistent right now. If you take your standard state-dependent pricing model, the slope of the Phillips curve for normal typical shocks where we think it's pretty small is much greater in these models. So there's a big gap between micro and macro consistent models that I think absolutely needs to be closed. There's some ideas out there that this may happen by, for example, ditching rational expectations, which I'm afraid to say are still well and alive in academic departments. But I'm very much in favor also of thinking about alternatives, maybe incorporating some of the inflation expectations research that Ed and his team at the Cleveland Fed have been doing very recently. So I think this is a big, big open question for macro research on inflation. So let me now say a few words about the current inflationary episode. And I think to understand the current inflation, one thing we absolutely need to understand and incorporate in our Phillips curves is that the Phillips curve does not seem symmetrically nonlinear as, for example, coming out of these state-dependent pricing models. Instead, I think the nonlinearity is very much to one side. It's very much a convex Phillips curve rather than some kind of S-shaped Phillips curve. And I think the reason for this is pretty straightforward. If you think about supply curves, there's pretty good evidence that supply curves are convex themselves. There's a very nice AR paper recently published by Böhm and Pandalay Nayar, and what they show is essentially that when demand goes up, real marginal costs go up, and that increase in real marginal cost, if you feed that into your favorite Phillips curve, is going to give you a stronger price response, especially if this is a state-dependent pricing model. Why do real marginal costs go up? I mean, just think about when firms get an increase in demand, they struggle to ramp up production, they try to source new inputs from overseas, they try to ship more goods to their customers. All of that at the margin becomes more and more expensive. And so this very naturally explains why in such a world, when you have large demand and a strong increase in inflation, you start to see things that look like supply shocks but are actually caused by the demand shock. For example, bottlenecks can start emerging, right? Think of the lines we had outside of the Port of LA, right? This is something that can very naturally happen in a framework where supply curves are convex. We see profits rising because it's real marginal costs that increase more strongly than average cost, and that can look to some like greedflation when it is actually just caused by an increase in demand. And in fact, it can all be compatible with a Phillips curve that was well alive in the pre-COVID period, just that we didn't have these large shocks that we're seeing right now. So there's definitely a lot more research on this topic that is needed, but I think it's absolutely crucial for understanding current inflation. Let me just say give you two examples for why it's important. The first one is that it really helps understand how these massive sectoral shifts that we've been seeing during COVID can drive aggregate inflation, right? During COVID, if you remember, I know it's uncomfortable, I don't want to think back either, but when we were back, at home, locked down, we spent a lot more on goods than services, right? And so we have this massive reallocation away from services towards goods. And this is something that I investigated in my own research with Guerreri, Lorenzoni, and Werning. And basically, what you could have thought is that reallocation effect causes sort of an equal-sized inflationary response in goods-producing sectors, and a equal-sized disinflationary response in service-producing sectors. Okay, but that didn't happen. And in fact, precisely because of the asymmetry I mentioned, we ended up with massive inflation in goods and no disinflation in services. And that went hand in hand with a strong reallocation of labor away from services to goods producers. And then 2021 brought the return of service demand, but many workers already had left the service sector. And again, we saw that return brought more aggregate inflation. So what's really funny about this is that we might be in the same place as we started from pre-COVID in terms of our allocation of spending across goods and service producers, and yet we've arrived here with two bursts of inflation going in both directions, moving away from services and back towards services. There's a very nice paper by Matteo Iacoviello and co-authors at the Fed board that really fleshes this out in a quantitative model. The second reason these asymmetries matter is pretty intuitive. Aside from these sectoral shifts, we also were in a period of massive fiscal stimulus. And of course, if you have a convex Phillips curve, that can mean that inflation might be surprisingly large relative to what we had seen in the past. And what's kind of interesting that, and that's a question I worked on with two of my co-authors, Oleksiy and Wrongley, is that this kind of fiscal stimulus is not a one-time thing. Just because we send people checks in 2021 doesn't mean the inflationary response is constrained to 2021. In fact, one thing we found is that these excess savings that people started spending down, they're not gone if you spend down your excess savings, right? If I spend down my excess savings, chances are somebody else in the US economy is gonna earn those excess savings. And so rather than being gone, they're just gone from my bank account, but they appear in somebody else's bank account. And so these excess savings can slush around the economy for quite a number of quarters before eventually they end up in some rich person's bank account that doesn't bother to spend them down, people with low marginal propensities to consume. And this is why we call this effect the trickling up effect. And that just explains how persistent the demand effect from fiscal stimulus can be, and also how persistent inflation can be. And with that, I want to turn to inflation persistence going forward. Let's do a thought experiment. If I told all of you right now that we would go back to price inflation of 2%, which I'm sure my co-panelists would love to see, right, from now on forward, would you be happy with your current nominal wage and 2 to 3% increases, just like maybe what you had before COVID, going forward? Maybe not, right? Maybe you feel like, and I certainly feel like that, I got a real cut in my salary because prices were increasing more quickly than my wage was, right? So you might want your real wage to be just as high as it was before COVID. And if that's the case, then inflation is not over, because then we would like to push for a higher nominal wage ourselves. That will eat into firms' margins. So firms will then, in that case, universities' margins. I don't know exactly how that will work. But then firms would start increasing their prices to protect their margins, and suddenly we have a full-blown wage price spiral that is active that propagates inflation forward. And I think two very nice papers on this topic have been written by Lorenzoni and Werning. And one thing they conclude, which I think is fascinating, is that inflation is pretty much always about these kinds of conflicts or disagreements, where workers like to preserve their real wages and firms like to preserve their margins. And as long as there's a conflict there that they don't agree, inflation will keep going. It's like conflict is the engine of inflation going forward. And I think what's really interesting is that this is potentially more relevant for countries where inflation is important, that we're facing, deteriorating terms of trade. Think of European countries, for example. Because in that case, the aggregate economy is poor. So some people will have to take a cut in real terms. And if firms and workers don't agree on who that is, we're going to see more and more inflation persist longer and longer. And this may make it hard to simply sort of write out an imported inflationary shock. Sometimes that's, a set of predictions or policy recommendations that comes out of our models. You shouldn't respond that much to imported inflationary shocks. Well, maybe with this new perspective, we should respond to it. And maybe it means that in Europe, we actually need a harder landing to bring, you basically break this cycle of wages and prices, this conflict, than we do in the US. So this, I think, is definitely a key avenue for further research. And with that, I'm going to conclude my remarks, and I look forward to our discussion.
Well, thanks very much. This was a very nice first round of remarks. So I know the audience is already having in mind many great questions, but to kind of build that up, I'll take time to ask a few follow-up questions And you guys are going to be in a tough spot because I asked you to come up with questions for researchers, and now I'm going to be asking questions about your questions. So, but you can do what you want. Maybe answering with a question to my question about your question. So. But I think so. One theme that I picked up so far, which also was present in the yesterday policy panel, is that we as policymakers or academics, researchers, we need to have this humility about what we've experienced and sort of how much we don't know about what's going on and sort of how to go about it. And so I'll start with inflation expectations, and I'm going to go to Ed first, but please, Ludwig and Catherine, feel free to jump in. So, Ed, you pointed out that when you look at surveys of household expectations or firm expectations, they're usually not so far from each other and very different from surveys of professional forecasters. You pointed out that maybe not enough attention is being paid to sort of the differences in expectations, dispersion, or even outliers. There's respondents, ordinary people, households, or even managers of firms that give completely insane answers to, what do you expect inflation to be in the next year? And of course, this comes from research by Gordyanchenko, and others that points out that general public is remarkably unaware of what monetary policy does, what it means for the economy and for inflation. So my question is, what does the central bank to do about this dispersion, or even sort of how far in a crazy direction some of the answers go? It suggests that there's this natural limit on how much central bank communication in its purpose of moving or controlling where inflation expectations are, trying to keep them anchored. This evidence suggests generally that there's probably some limit on how much central bank communication of their policy can achieve. So I was just wondering, does it mean central banks should push on with their sort of trend of being more transparent, put out more information out there, think of better ways to communicate it, or maybe not so much in the view of that this may not go all the way to succeed?
Well, so thanks, Oleksiy. So I think there certainly is a trend in central banking toward more communication being better. And so I certainly believe that that's the right path to continue to go down. But I think we probably need to be very humble about how, there's going to be limits on how much we can reach the typical person on the street, because not everybody's paying attention to press conferences, not everybody's reading speeches. But then I think, there's opportunities to think about how you can more creatively craft messages, right? So, how can you embrace social media to put your message out there? And different central banks have done that to different extents. And so I think, we can certainly learn from each other. But, even within, even if you're putting out your message, it's a clean message, it's a succinct message, it's, the length of a tweet. Different people are going to have different views, right? And so I think it's kind of incumbent on us to figure out what does that mean for the economy. And, to also think critically about some of our own performances, right? So if I, ask professional forecasters in June of 2021, what did you think inflation was going to be 1 year forward? How many people guessed 9% CPI inflation, right? The mass in that part of the distribution was basically zero. I'd have to check the SPF, but don't quote me on that exact number. But so it just goes to show that things that the profession might think are unreasonable or zero probability events can actually happen. And I can tell you that during the pandemic, we were asking consumers, what do you think the pandemic's going to do to inflation? They thought it was going to have a big positive impact. So the consumers were right. And the professionals actually were, farther away from the actual event in some sense. So, so I think there's a certain degree of humility that I think we need. But I think, again, in the spirit of this panel, more research in terms of how can we reach those people, what techniques can we use to reach them through communications, and then what does it mean if you're not reaching everybody? What does that mean for the monetary policy transmission mechanism, for inflation dynamics? I think those are all very important questions to keep pursuing.
And Catherine, you mentioned that in your, what you considered when you were contributing to the decisions, you mentioned this channel that works through inflation expectations. So does this kind of evidence that comes from surveys of expectations of households and firms, does that give you a pause, or maybe the other way around? It does inform in some way sort of which way your decisions will go?
Well, in my case, in the research that I have talked about, I gave you an example from my, Natalie Burr's master's thesis, but there's also a work that was done last year internal to the bank using the decision maker panel, that in fact there is an independent channel of monetary policy to affect inflation expectations, so that the sort of a standard Phillips curve where you've got, inflation and output gap is an incomplete representation of the Phillips curve. And in fact, the drift term is very much, and you mentioned convexity, Ludwig, but not drift. The drift term is inflation expectations. And you couch the language that us central bankers were still in the macro world. All of my Phillips curves are micro foundation Phillips curves. They are price-setting firms that are not atomistic actors. So I have that channel. I've got that. And what you point out, though, which was this gap between a macro model of inflation and a micro foundation model of inflation, is exactly why we end up with this difference between, not the only reason why we see it, but the difference between the mean and the mode in our inflation forecast, because the modal forecast comes from a macro model. So, I mean, I do think that we increasingly see a role for inflation expectation as an independent channel. It is controversial. Not everybody on my committee or in the research community at the Bank of England agrees on this. But I believe that increasingly the research is showing that is a separate channel, and it's a variation, if you want to call it this, a variation on the degree of anchoring. The point that Ed made about communication, maybe it was you were saying that. So there's communication, and then there's forward guidance. And the two of them are not the same, right? We try very hard to communicate how we make our decisions. But in this environment of great uncertainty, that is where the language data dependence becomes an important communication device, as opposed to giving forward guidance about where we're going. We're telling you what we're looking at. You can look at it yourself. We're telling you what we're looking at. Each one of us, in the Bank of England, our votes are completely transparent, and we give enough speeches so that you know why we voted the way we did. So we're giving you our individual reaction functions and what we're looking at. It's kind of up to you to figure out how to add that up to the majority vote at any meeting. And that's what, of course, the financial market people spend most of their time trying to figure out how to do.
Can I just react real quick? I'm going to be a bit provocative. I'm not sure how important household inflation expectations are for their spending behavior. If I personally run into a store now and I see that Starbucks has raised prices, I'm going to be discouraged from buying. I'm going to be like, oh no, I don't want to give them more of my money. It was already expensive before, now it's even more expensive, right? So I'm not sure the Euler equation, right? The Euler equation logic would be, okay, I know the nominal interest rate. I know I have my inflation expectations. I subtract one from the other. I get a real interest rate, and then I, decide when to spend. I write these models, but I'm not even doing it myself. I don't even know what the nominal interest rate is on my bank account right now, right? So I'm not sure exactly, to what extent that part matters to the monetary transition mechanism. I think there's other parts that are very, very relevant. I'm just not sure how relevant inflation expectations are for exactly these spending, for spending behavior. I know there's some research out there that thinks about this, by some people in the room even, but I'm not yet there to sign off on the other equation.
And Catherine, I was wondering, because you said your Phillips curve is the micro Phillips curve, I was wondering, is that because ONS, the statistical agency that constructs the CPI for the UK, they put out their micro data online and they update them regularly, unlike most other statistical agencies, certainly not the BLS or Statistics Canada. So I mean, it's something that is worth emphasizing today, that to inform micro Phillips curve, researchers need data. Data requires access, and access is usually sort of difficult to get, or whatever access they get is difficult to work with. And I think ONS is a great example of a statistical agency just putting the micro data out there, and turns out this doesn't lead to any problems. If anything, it just creates great collaboration between researchers, policymakers, and people who construct the CPI. Okay, just another point I wanted to pick up on comes from what you said, Catherine, about some research that provides prescriptions for policymakers that seem to go contrary to sort of the accepted playbook, if you will, or principles of how policy should be done. So you mentioned that some research prescribed that under certain circumstances, the decisions after, I guess, a similar shock like during COVID should be front-loaded. So the responses of policymakers should be sooner than they're used to. So that seems to go against the usual interest rate smoothing kind of principle that seemed to have worked quite well in the past. And if I'm not mistaken, if I remember correctly, your paper, Ludwig, is that the prescription in your paper with Guerrieri and Lorenzoni was also that, in the wake of this shock, that is supply shock, but kind of works like a demand shock as well, there's this massive sector reallocation that would imply that the policymakers should help that reallocation because it puts resources where they're more productive. And so, again, points towards sort of imminent, fast action that would ignore sort of bad expansionary action in this case, that would ignore maybe contraction in at least some of the economy. And one more example I wanted to give that goes against the sort of conventional wisdom is some research, one of them is The Bank of Canada by Paul Baudry, shows that if you relax rational expectations in otherwise standard model, then the prescription to look through temporary supply type shocks that has been recommended conventionally before is now no longer applies. That the response should be quicker, should not be looked through such a shock, and as soon as inflation crosses some threshold, monetary policy should react. So just broadening this out, what are your thoughts on generally how much central banks that review their frameworks, and they do that now regularly, how much they should think about changing the ways that were fine for them, in the previous decades? What kind of questions they should ask? We already touched on 2% inflation. Is that still viable? Should they rethink their mandates? Should they lean towards not just a single inflation stability, price stability mandate, but go toward multiple mandates? Should they go back and think again about financial stability, monetary policy nexus? Should they think about fiscal policy, monetary policy nexus? What are your thoughts more generally, whether there's more urgency now, even though we're still sort of getting over the COVID experience, to incorporate some of these important questions into the review of the frameworks. I told you it's going to be tough.
My mandate comes from Parliament. I think it's very interesting that there are a range of central banks having different mandates and different ways of achieving their mandate, whether we call it flexible average inflation targeting, or whether there's more than one indicator that is part of the sample set that the central bank uses to evaluate whether or not they're on target. There are other central banks who have ranges, and there's other central banks who have at one point used below a number as their objective and then kind of changed the language to be symmetric around. So there have definitely been, there's a variety of different models out there that to me would create a great set of compare and contrast research papers on is there a right type of strategy considering these, I think I gave you 4 different, 5 if you include mine, of different approaches to achieving the mandate. It's described in different ways. The problem with choosing, kind of evaluating, well, is one better than the other, of course, is that there is not the same shock. Each the countries have different shocks, even in the context of COVID, Ukraine, as being kind of global shocks, but how that manifested itself in each one of these countries is different. And of course, it's also a case that the institutional structure in the countries is very different. And then thirdly, of course, the fiscal policy responses both to COVID and to the energy surges were very different. Nevertheless, one could imagine setting up a horse race of these different strategies for a mythical central bank facing a set of shocks that kind of looked like the ones we have. So you have a mythical central bank and a mythical economy. It's kind of theoretical structure that you could go ahead and run this horse race and see whether or not you actually found that there might be a best way achieving the target.
So I guess I would just build on that as an advisor. So a lot of the time with policy, it's about risk management, right? You face certain risks. You have a realized situation. You face risks around that. And how do you manage those risks? And I think approaching a framework review in the same spirit is useful, right? So there's a risk of hitting the ZLB. Okay, so how would you address that? There's a risk of massive supply shocks, de-anchoring of inflation expectations. How would you address that? So, and I think, so from the Fed's review, there's many documents that are out there publicly available. You can see some of the analyses that were done. And so I think that, in my mind, that's a key part of a framework review, is not just, okay, here's what we're planning to do, but here's how this framework would handle all these different risks that are very different than maybe what we've faced in the past. So, or something that was last seen in the 70s or the 50s. How would those situations be handled under this new framework? I think, thinking in terms of taking the risk management framework you think about for policy decisions and applying that to the framework, I think is a useful way to start.
Can I just add?
Yeah,
I'm not a central banker, but one thing that would be troublesome to me is when we struggle getting inflation back down, we discussed a higher inflation target. I think that doesn't bode well for some of the credibility that we really want the central bank to have. So I think it's great that's a mythical country that is debating that, and not a real one right now.
Okay, thank you. And so I suggest we open up to the audience and look for questions on anything we discussed or whatever you would like to ask.
Hi, thank you. Very interesting. My name is Kai Afai, researcher at the Bank of France, and I like to follow up on Ludwig's point about the distributional conflict about inflation. So one way to think about this is also to say, well, we observed now a massive drop in the labor share and aggregate income, right? And depending on the view of our world, we might think, okay, we have a constant, more or less constant labor share over time. So any way back to the natural equilibrium would then entail, of course, some rise in real wages. So what I never really understood was why central bank officials like go to the public and to the media and say, oh, please do not raise wages so strong. But at the end of the day, we know if the labor share is constant that this needs to happen at some point. So I'm really wondering like how we should think about the best way to get back to this equilibrium.
Am I free to go? Yep. Yeah, I think it's a really fascinating question. I think one thing that matters a lot for the dynamics of the labor share is which kind of shock the economy is hit by. Like, for example, for European countries, where a lot of the inflation is coming through imported energy prices, I do think that there has to be a real adjustment, and I'm not sure real wages have to go back to the same sort of pre-COVID, pre-war in Ukraine level. So that's where I'm not sure if you know, just going back to the pre-crisis real wage is sort of a, you know, would be a good policy for to pursue. I think in the U.S. I would be more optimistic that real wages return to the pre-COVID level.
Martin Stürmer from the IMF. I have two questions. One is, we have seen these large energy and food price shocks last year. You're already alluding to it. So what is your assessment about the pass-through to core inflation from these really large outsized shocks? And we could see more of them in the current geo-economic fragmentation environment. Second question is there one thing that you would have done differently over the last year in fighting inflation? Thank you.
I'll take the first one if you want to take the second one, Catherine. So on the first one, so you know, I guess I'm of the view that the underlying inflation regime matters for pass-through. And so, you know, again, going back to the Faust and Wright type of world, we had a long stretch where you could be hit with these big, even big energy shocks. And if inflation expectations are stable, the world is pretty stable. Otherwise, a lot of that can dissipate pretty quickly. And so I think now we're in a regime of more uncertainty where there's a greater risk that inflation expectations are already high. There maybe is passed through into wages, maybe not. You know, I think that's an open question. I think the connection between the labor market and inflation and wage inflation and price inflation that I think we could have raised earlier and didn't. But so in my mind, I think we're more exposed and more vulnerable now to energy and food price shocks passing through to broader inflation dynamics than would have been the case pre-pandemic. And it'll be a while before I think we have a sense whether that's permanent or just transitory.
I would add to that the research that shows the salience of energy and food for the formation of inflation expectations. And so we could argue that when those energy and food prices come down, that will have a salutary effect on core inflation as well. But that's after this duration comment that I made before, and after the embedding into the core inflation expectations. So it's part of the persistence story. I would add the regime of uncertainty that Ed was mentioning comes back to my assessment of the prospects for dynamics of asset prices, regular prices, and economic activity going forward is one of much greater volatility than was observed during the Great Moderation period. and that creates an environment where central banks have a harder job to do if you have more volatility in the environment. And how we interpret a harder job to do is a very important question going forward.
Can I add something? There's nothing more enjoyable for a professor to advertise your students' papers. I just had a student on the market. He is going to the Fed board, prices and wages, and his job market paper is exactly on this question. Like he looks empirically how fast and large pass-through from oil price shocks to core inflation is through the entire supply chain, network, and he finds that it's actually very significant. It comes with a delay, but it's a very significant pass-through overall. And one thing he does is he looks at the recent decline in core inflation and how much of that is coming through the decline in oil prices that we saw last year. And he says that some of that is actually just a consequence of that and not actually, softening core without that effect. So that's maybe Robbie Minton is his name. So.
Please go ahead.
Thank you for the wonderful panel. Guido Ascari, Dutch Central Bank. I have a couple of comments on what has been said here and the questions, and I would like to see your views. So one is about, I think you didn't answer about the fact what the central bank should have done differently. but there's been this surprise, abrupt surge in inflation. And we can argue that monetary policy was behind the curve, or maybe it was fiscal policy or whatever. But I would like to push an alternative interpretation, and possibly more worrying for central bank, which is actually inflation becomes less and less controllable because it's not domestically determined. So the idea is that a lot of the costs of firms are actually internationally driven because of the fragmentation production, supply chains, more integrated goods market, intermediate goods, services also now becoming more and more integrated worldly, and also financial markets. And I think one case in point is Japan. So Japan inflation now is running at 4% month-to-month annualized rate. And Japan has been trying for 30 years, throwing everything, the kitchen sink to the economy to rise inflation. And they didn't manage. The three arrows: massive fiscal policy, massive monetary policy, supply policies, like encourage women to go to the job market, and they didn't, that was not sufficient. So, and now inflation is back and is actually pretty high even there. So that's the first comment. The second comment is about conflict and things. So if we think about equilibrium models, that's not really a problem. So, there's an equilibrium, long-run equilibrium, in which there is a given distribution of the pie, or the cake, let's say, between wages and profits. And so this conflict, and also if you think in terms of dynamics, wages is just a part of the cost. So even if I want to keep my wage by 100%, the inflation indexation, this cannot be a spiral out, because it's just a fraction of the cost. And I want to keep my margin, so I increase the price by alpha of the increase in the cost, and this has to converge. So this idea of conflict can be there only if we go and start thinking about these equilibrium models, in which these guys don't understand that the pie now is smaller because of the terms of trade shock, as Ludwig said, and they want to keep the real wage the same as before in terms of level, not in terms of distribution. But then there's a long history of this literature. And then, you just open the Cambridge Journal of Economics, the Journal of Post-Keynesian Economics is full of papers about in which distribution is conflict. I come from Italy. I'm old enough to remember Ezio Tarantelli. Ezio Tarantelli is one of the best economists of his generation in the 70s. He was killed by the Red Brigades exactly because it was against automatic indexation in Italy. And the debate at the time in Italy was all about real wage is an independent variable, and inflation arising in the 70s because of conflict. Thank you.
The one point I would make about, with regard to sort of your set of comments there is we spend, or I spend my time on the transition path all the time. I'm not in equilibrium ever, right? So, you know, whether we call it conflict or whether we call it dynamics or, you know, the relationship between costs, inputs, and final prices, it's all, the parts are always moving. The parts are always moving, and that's the environment in which I have to make judgments.
Just a thought, I think the comment is great, and in fact, I think the paper that I cited by Lorenzoni and Warning, I think they actually discussed the relationship to previous post-Keynesian work, which I think is excellent, and people should look more at this kind of work. My sense is that in the negotiations, let's say in Europe, between unions and employers, it's not very much about the distribution, it's more about the level. So that makes me more worried about this being a bigger deal than not.
And on the first question, I think, if I understand correctly, a question, Guido, it was an example of a view that maybe inflation is inherently more volatile. Sorry if I don't interpret it correctly, but I mean, more generally, in your remarks, it sounded we have this theme that you know, was this one-off event associated with sort of the underlying event, pandemic, global, that is all but, you know, gone away? Does that mean that we should soon expect that inflation process will sort of return to the process we had before, or is there a sense in which some parts of the process changed? Catherine, you mentioned, you know, you look at recent data, you see everywhere properties of the process that we haven't seen in a long time. And so do you see more generally, do you think either volatility, inherent volatility has changed, or any other part of the inflation process has changed, or you think we're mostly going to go back to the process we had before?
I think that is a important question that each policymaker is facing every time they have to make a decision. And they will, you know, each one of us comes up with a different assessment of how close we might be to the linear, symmetric world of the previous environment. My sense is that we're relatively far away from that, which is why I asked the question about duration. And I believe that we're not actually going to get, even if we got back to linearity, and I don't think we're going to get back to symmetry, frankly, because in a more volatile environment, you've got downward rigidity on prices and wages, and so you have inherent bias upward in an environment of a greater underlying volatility. So that means it's, and it could be geopolitical, it could be supply chains. I mean, there's a variety of different things we could point to for the underlying fundamentals of the economy being ones more prone to shocks, more prone to volatility. And as I say, in an environment where you have downward bias, everybody knows about the downward bias to wages work, but there's a lot of downward bias in prices as well that you can see when you look at the firm level data, the symmetry, the detailed firm level data. So that puts an inherent upward underpinning, upward tailwind to the aggregate inflation process.
Thank you. And regarding the question that hasn't been answered twice, I think I think, you know, obviously this is what we're trying to do all here for the last year or so, or whatever. It's just difficult to answer, and it takes time to answer that.
I stand behind my votes. I am very comfortable with how I voted, and you can read my speeches as to why.
Did you have a question?
Yeah, well, I was going to double down in this direction to be provocative. Yeah, sorry, I was going to double down a little bit in this direction, but maybe I don't have to. So I was wondering if you know, at the meta level, you know, the Fed was a little slow, but the European central banks were also perhaps even more slow to pick up on tightening. While in other parts of the world, and this is it's an international conference, right? Think about Brazil, Eastern Europe, central banks tightened a little bit earlier. Do we need some kind of research into the structure of central banking? Maybe it's also sort of a question for everyone. To understand, is there something we can learn from each other in particular, but also structurally, right? Or it's also a question for academics. Should we think about the structure of central banking, also in the face of large shocks? So obviously there's a lot of credit for high volatility there.
Well, I was suggesting that mythical central bank horse race.
Right, but I think one of the issues is that central banks typically have a domestic mandate, right? And so I think that's something that you struggle with. So I think certainly more research on global interactions, policy interactions, the global drivers of inflation, and the extent to which it is controllable. I mean, I think that's great, desirable, but you have to somehow reconcile that with the domestic mandates that are usually assigned, or like the continental mandate for the ECB, for example. So that I think is an important constraint that you should put into that research.
But I have to say, we incorporate spillovers and spillbacks. The UK is a small open economy. We definitely pay attention to what happens in the neighborhood, both sides of our neighborhood. And we recognize, we don't have much of an impact outward, but it's very important to keep a sense of what's going on in other economies, and that's in general true. There's always a global factor that is larger or smaller, depending, that it gets incorporated in the decision.
Nice to be here. I must present myself. I'm an economist from Georgia, a country which has a border with Russia, and we are actually for the moment occupied by Russia. And so nice from you. You are the first person from whom I heard here, unfortunately, about the shocks created by this war and Ukraine. And sorry, I'm a bit nervous. When we are speaking about the Eastern economic countries, Eastern European countries and developing countries, it's just a remark. I'm so much grateful for the Federal Reserve and central banks being slow. I'm working on a thesis which is about retro economics. You understand what it means? Since our countries are always lagging behind due to all these high standards, which are dictated by the countries so much high, like America, England, and you're already developed, and your welfare is far, far away from ours. And the one thing I'm grateful to your slow pace. Why does it exist, your slowness? You are thinking about the prices in Starbucks, thank you. You are thinking about the customers, thank you. And you are speaking that developed countries should look at developing countries and take an example. No, it's not right. People suffer. When you tighten the policy, you think about liquidity, you think about inflation, you think about forward guidance, you think about the slopes, but nobody speaks about the society. And what is the society in the end? It's the society who votes for the president. And this is the greatest shock we should avoid. For instance, I've been discussing some matters with the colleagues here. The greatest shock from this inflation is not about banks, it's about the customer. It's about the customers. For instance, we had this example of Silicon Valley Bank, where people had a panic because of this expectation. And this expectation, when you tighten the policy, you immediately increase the risk of inflation. And when you are going slowly, you are decreasing this expectation. You don't create panic. So we should think about the psychological aspect of the society, which is the main thing in this inflation. We're just speaking about the curves, but we don't speak about the people who create these curves. And usually we had a pandemic, and a pandemic in this curve, where is it? It's an outlier, just 0.00001% of 100. And when we speak about tightening, we should think about the expectation and the real psychological effect. So I don't know how to do it. I'm still working on it, how to create a perfect model. Still, there does not exist a perfect model to do a successful transit from lagging behind economy, undeveloped countries, misdeveloped countries, which in real we are because we did not finish our wars and we still are under the danger of being bombed even today. We never know what comes to that crazy man's mind. And we're speaking about such a high thesis and high risks. And in real, we should think about psychological aspects more. So tightening is good, but I think that slow pace and gradual pace is very important. Let's think about the people who stand behind the figures and behind the curves. It's only people behind it, not just the figure. Thank you so much. Thank you.
Thank you for your remark. We may have time for one last question, if there's one from the audience. Yes.
Yes, hello. I'm Julian Kozlowski from the Federal Reserve Bank of St. Louis. I want to bring back the point about the framework review that apparently is going to happen quite frequently, every 5 years or so, and there is one coming next year when we have an inflation that probably is not going to be back to 2%. So I want to go back to the point that Ludwig mentioned about if this can affect the credibility of the central bank and what are you really trying to achieve with these frequent reviews, because we know that inflation is a slow-moving process. If you look at the history in the US and across countries, it's hard to control inflation in those short windows of time. So how do you want to address? And I'm particularly worried about the next meeting of this framework review, which inflation is probably not going to be back in 2%. So what is going to be the outcome of that meeting, and what are you going to try to achieve with that? And thank you.
That's a Federal Reserve question.
Thanks, Catherine. Well, since this panel is really about questions, I think that this goes into the question category, right? So, I think it's fair to say, though, there's a few questions that you're raising, right? So what's the right frequency of reviews, right? So for a long time, this wasn't kind of an established process, and now I think central banks are of the mindset that we should do this regularly and maybe schedule them and less, do less of the ad hoc types of reviews that might be perceived as changing the goalposts midway through the game. So in that sense, scheduling them, there could be a benefit to that. But what the outcome of the next review will be, I think that's unforecastable, especially among these panelists. But I think that it's clear, though, if you look at the documentation from the last review, that research matters for these reviews. And so, I guess the challenge for all of you is, because obviously Management 101 has turned the question around, is, the research that you're putting out there matters. And so, we look to that research to inform, what is the best framework to be using, and what's the range of shocks that could be hitting, and how would different policy frameworks respond to those shocks. And so I think I would encourage all of you to be thinking critically about, the policy issues of the day and how you can contribute to them. And so all of you are doing that in ways both big and small, and I would just suggest keep doing that. So.
All right. On this excellent note, we have to conclude. We're out of time. So I would like to thank organizers for putting together this excellent panel. And of course, it's my pleasure to thank on your behalf our excellent panelists for the discussion. Thank you.